In this video, I'm going to educate you on a concept called S corporation stock basis. Every single S corporation owner needs to understand this concept, but rarely does their accountant teach them about it. I'm going to show you an example though of how not knowing about this can cost you well over $5,000 of taxes. Now, I'm sure I've already lost some of you already, but let me explain why this is important and why you should keep continuing to watch, okay? And I'll explain this in layman's terms. If you take distributions from your S corporation in excess of your basis, and I get it, right now you don't know what basis might really mean, the excess distributions will be taxed as capital gains. That might be short-term capital gains, which is ordinary income tax, or long-term capital gains. And it's so easy to make this mistake, meaning take distributions in excess of your basis. So I want to avoid you making that mistake yourself. So please, keep watching. All right. So let me transition over to here. I created this for you on Excel, and we can walk through this together. Also, what you're going to learn by watching this is like how a basic profit and loss statement works and balance sheet works. So you're going to learn more than just the basis topic if you continue watching. All right. So here we go. Let me kind of give you a layout here of what we're looking at. I've got these different colors here, right, of these different values. And so one, we're going to go over company financial. So this might be your business and what did the numbers look like for the year. Then I'm going to cover what is the basis that is calculated or occurring while you're doing your business this way. And then how it also, if you ran your business this way, how much cash you have in the bank and how there's a difference between how much cash in your bank that you have and your impact on your basis. And that's where this problem occurs. Okay. I know it doesn't make a lot of sense right now. It's going to though here in a moment. So we have your business here, right? This is a P&L, profit and loss statement. You might call it an income statement or whatever. So let's just say you have a business with $100,000 in revenue. Okay. And you actually have the combined value here in expenses, which is $60,000. I just picked these numbers arbitrarily. But notice that I kind of disaggregated the amount of expenses you have, and I put it in two different categories. I said $12,000 expenses paid, and let's say you paid these expenses with cash, all right? So you either paid with actual physical cash, a debit card, or a check, okay? Or maybe you used a credit card, but you paid down your credit card. That's what I mean by $25,000 with expenses you actually paid. But then you also had, in this example, $35,000 of expenses that you put on a credit card and you did not pay that balance down. So at the end of the year, you still own $35,000. Well, on your profit and loss statement, you could do the math here, right? 100 minus the 25 minus the 35, you have $40,000 of profit in your business. Let's look at the balance sheet, okay? The balance sheet has $1,000 of cash in the bank. There's $35,000. You'll come to see why there's only $1,000 left in the bank here in a second. $35,000 in credit card debt, right? That's this up here. $35,000 in liabilities. And then in equity, we have $1,000 in capital stock. That means that's just your capital contribution that you started the business. So let's say it's year one. You put in $1,000 to start this business, so you have $1,000 in capital stock. You have $40,000 in net income, that's this number here, but you took $75,000 in cash out of the business. You took out $75,000 in distributions, okay? Well, your total equity now is negative, right? You took out 75 grand, and so your equity in the business is now minus 34,000. So let's look at what's this concept of basis and what's happening to the basis as your business is being ran this way, okay? So this concept of basis, this is not the technical definition, but I'm going to call basis for, again, in layman's terms, think of it as sort of skin in the game. What do you have invested into the business personally, okay? And that could be what you have contributed in the form of capital. It may be what you've contributed in the form of debt that you've loaned the business. It may be the profits of your business that you've earned have all created basis, okay? And I'm going to show you that here. So you ran your business the same way, right? You can see it's the same stuff that I had over here on the left. 100 grand of revenue, $25,000 of expenses, $35,000 of expenses that were on the credit card that were not paid yet. You have that liability, and you have $40,000 in profit. Okay. So right here, you're creating $40,000 of basis. All right. This $1,000 of cash that you have in the bank, that's not creating basis here. It's creating it further down. I'll show you that in a second. These liabilities are not creating any basis for you. You have your capital stock. That's basically this money. That's the cash in the bank. It's there in equity. And so you've created $1,000 of basis by doing that. But then you lost $75,000 in basis because you took $75,000 of cash out of the business. Okay. So now you actually have technically like a negative basis situation, but with an S corporation, basis cannot go below zero. So what you've actually done is reduced your basis down to zero, and you have something called distribution in excess of basis. Okay. And so it's $34,000 that you've done. And this is taxed as capital gains. Could be short-term capital gains or long-term capital gains. So let me show you the issue here, and then we'll cover these other columns here. So I'm going to give you the benefit of the doubt and say that you've had this stock. You started this business greater than a year ago, so your stock was issued more than a year ago. But if this is your first year in business, it might not be long-term capital gains. It might be a short-term capital gain, which is ordinary income tax rates, which could be taxed if you're in a high tax bracket up to 37%. So just by having this negative basis issue could cost you $12,580 in taxes. But I'm going to be nice and say that it's long-term capital gains, and you're not making a ton of money, and so it's probably taxed at 15% instead of 20%. Well, this mistake is costing you $5,100, okay? Because you're paying long-term capital gains tax on $34,000. Okay, so you might be wondering, like, well, how did this person even get into this situation to begin with? Let's look at what's happening here in cash, okay? How, if your business operates this way, what's happening to the cash value or the cash amount, okay? So let's just assume that when you sold $100,000 worth of services or product, you got $100,000, right? So you had $100,000 of cash if all this happened on one day, right? Then you had $25,000 in expenses that you actually did pay, right? Remember earlier I said you paid this amount of money with either cash or checks or a debit card. But then you had those $35,000 of expenses, but you didn't pay them. They're a liability. So you still have that cash in the bank. So you actually have $75,000 worth of cash, right? The 100 you received minus the $25,000 of expenses, and you got $75,000. Now, what else is happening in terms of cash? Well, you have that $1,000 that you invested, right? Your capital stock. You still have that. So you really have $76,000 in cash at that point. Your liabilities don't really affect your cash. That's why they're a liability. You still owe them. But then, unfortunately, you took $75,000 in distributions because you didn't realize that this would be an issue. So you took the 75 grand out, and now your basis at the end of the year is only, your cash at the end of the year is only $1,000 that you have in the bank, right? Just like we said here, your assets are $1,000. That's the cash you have in the bank. So you see how this can happen. You thought you had 75 grand that you could distribute to yourself, but in reality, you only had about $34,000 or so that you could distribute to yourself without having this issue. Actually, sorry, $34,000 if the distribution in excess. So you had 75,000, minus the 34,000 that you could have distributed. So you distributed too much is the bottom line here. So this is how this can happen, right? You might be asking yourself, well, how could someone take out 75 grand? This is how, because they purchased a lot of this stuff on a credit card and didn't pay it down. How can this be avoided? Okay, let's look at this topic here. How can this have been avoided? So you can avoid this by paying down the credit card, right? That would have been smart. You could have made a capital contribution to create more basis. So at the end of the tax year, if your accountant is looking at this, they could have said, hey, you need to put some cash in the bank or you're going to have this issue. You could have done a shareholder loan to the business. So you, the shareholder, is putting money into the business in the form of a loan. You got to do that properly. It can't be a fake loan. It can't be just, saying that you did it. There should be a written document. There should be an interest rate. The business should be paying you the interest. So it needs to be documented. You could have taken less of a distribution. All right, that could be another way. And then any combination of the above. You could have done any of these four things, a little bit of this, a little bit of that, and avoided this issue. How else can you create this problem? Well, you could create this problem by taking out a business loan, receiving the cash, and then distributing the cash to yourself. So that's something that I bet, I've been saying this like within the sort of CPA community for a while. So many people took out these EIDL loans back when COVID occurred, received the cash in their business and distributed the whole thing to themselves. Okay. But they didn't report it on their tax return because they were working with a shady tax preparer or a tax preparer who doesn't actually understand how this kind of stuff works. Okay. Before I let you go, let me show you on the IRS website where you could read more about this if you want to do that on your own. And if you're a tax preparer out there watching or CPA watching, I know that there's other issues like debt basis and things like this, but I'm trying to just explain this to the average sort of new business owner who doesn't understand those concepts. So I'll leave this in the link in the description below. You can go to the IRS website and read this. One of the important things I want to highlight here is it says here, the IRS, it is not the corporation's responsibility to track a shareholder stock and debt basis, but rather it is the shareholder's responsibility. It's your responsibility as the business owner to be tracking this. And I'll tell you what, a lot of times your tax preparer is not tracking this. For years, tax preparers didn't really have to fill out any forms to track this. But the IRS has said, not so fast. We're tired of this. You are now required, as of 2021, tax year 2021, if you take distributions out of your S corporation, to file this new form. This is why, the cost of preparing your tax return has increased over the years, is because the IRS keeps giving us more work and more forms to fill out. And so I'm not going to take you through this form, but basically you need to show the IRS in black and white how your stock basis and debt basis is changing. And if you take a distribution in excess of your basis, you're going to have a problem. I believe it might even say that somewhere here. It says, I know you don't know what these lines are, but if line 6 is larger than line 5, subtract line 5 from line 6 and report the result as a capital gain on Form 8949 and Schedule D. See the instructions. The instructions will tell you more. Okay, so I'm just letting you know I'm not making this stuff up. This is a real problem that's going to happen, but I know, the average business owner is not going to really care that much. So let me know in the comments below what you think. For those of you that are watching one of my videos for the first time, maybe, my name is Navi Miraj. I'm a CPA that helps entrepreneurs save thousands of dollars in taxes. I do that by creating free content on social media, but also via a course I created that teaches business owners all of the strategies I use with my very own clients and my tax practice. So you can check that out on my website, which is navimirajcpa.com. But with that said, don't forget to subscribe, share, or like this video. Maybe you have a business partner, you guys have done this together, maybe share them and be like, hey, are we in trouble here? But if you're watching on YouTube, check out these other videos that are going to be playing here in a moment, and I'll either see you inside of the course or in the next video.